People often ask me what my secret is. They expect something clever, some new formula, some hidden system, and I usually disappoint them because the truth is, most of my success came from not doing very much at all. That may sound strange in a world that rewards activity, a world that tells you to trade more, react faster, stay busy. But over time, I learned something simple. Activity is not the same as progress. In fact, in investing, activity is often the enemy of results. When I was younger, I thought investing was about intelligence, about knowing more than the next person, about finding clever ideas. But the longer I stayed in the game, the more I realized that investing is less about IQ and more about temperament. It's about behavior. It's about how you act when everyone else is moving. One of the most valuable lessons I ever learned was this. The stock market is designed to transfer money from the active to the patient. And patience, I discovered, often looks like doing nothing. No, when I say do nothing, I don't mean laziness. I don't mean ignoring reality. I don't mean refusing to think. I mean something much harder. I mean resisting the urge to interfere with a good decision. Most people don't lose money because they bought bad businesses. They lose money because they couldn't sit still. They buy something sensible and then panic. They sell something valuable because someone else is selling faster. They turn long-term ownership into short-term speculation. Behavioral economics explains this better than I ever could on my own. Human beings are not wired for long-term investing. We are wired for survival, for immediate threats, for fast reactions, and the stock market exploits that wiring beautifully. One of the strongest forces in human behavior is loss aversion. We feel the pain of losses far more intensely than the pleasure of gains. So when prices fall, our instincts scream at us to act, to escape the pain, to do something. And most of the time, that something is the wrong thing. Another powerful force is action bias. We feel productive when we act. We feel responsible when we intervene. Doing nothing feels passive. It feels negligent. But in investing, doing nothing is often the most responsible choice you can make. I've watched this play out for decades. Markets fall. Headlines get louder. People start explaining why this time is different. And suddenly, patience looks foolish. But let me tell you something that experience teaches you very clearly. Most of the money I've made came from sitting on my hands, not from trading, not from timing, not from reacting, from waiting. When we buy a business at Berkshire, we don't ask, what will this do next quarter? We ask, what will this look like in 10 or 20 years? And once we're comfortable with that answer, we don't need to keep checking the price. Because ownership isn't about watching the ticker. It's about letting time do the heavy lifting. Time is the friend of a good business and the enemy of a bad temperament. There's another bias that makes doing nothing so difficult: overconfidence. People consistently overestimate their ability to predict the future. They believe they can exit before the drop and re-enter before the rise. They believe they'll know when to act. In reality, very few people do, and those who try usually discover expensively that the market humbles confidence. I've always said that the stock market is a device for transferring money from the impatient to the patient, not from the uninformed to the informed, from the impatient to the patient. That distinction matters. You don't need to be smarter than everyone else. You need to be calmer. One of the reasons our approach looks so boring is because it avoids stimulation. No constant decisions, no rapid feedback, and human beings crave stimulation. That's why casinos don't look like libraries. The market offers constant temptation. Prices move every second. News breaks every minute, and none of it changes the value of a good business in the short run. But it does change how people feel. Behavioral economics teaches us that emotions drive decisions far more than logic. Fear, greed, regret, these are powerful forces. And the do-nothing strategy is really a defense mechanism against those forces. By deciding in advance to do less, you protect yourself from your worst impulses. I learned early on that if you buy something wonderful and it temporarily goes down, that doesn't make it less wonderful. It just makes it cheaper. But only if you can stay rational. Most people can't. That's not an insult. It's human nature. Another bias that works against us is recency bias. We give too much weight to what just happened. If the market has been falling, we assume it will keep falling. If it's been rising, we assume it will rise forever. Neither assumption is reliable, but both feel convincing in the moment. The do-nothing approach neutralizes recency bias. It removes the need to constantly update your beliefs based on noise. It keeps you anchored to fundamentals instead of headlines. I've also noticed that people confuse movement with progress. They believe that adjusting constantly means improving. In reality, constant adjustment often means abandoning good decisions prematurely. At Berkshire, one of our greatest advantages is that we don't have to act. No quarterly pressure, no performance chasing, just the freedom to wait. And waiting is powerful, because compounding requires uninterrupted time. Every time you interrupt it through taxes, fees, or emotional decisions, you weaken it. Compounding doesn't ask you to be brilliant, it asks you to be consistent. And consistency is easiest when you're not constantly intervening. I've often said that investing should be like watching paint dry or watching grass grow. If you want excitement, go to Las Vegas. But if you want wealth, learn to sit quietly. That advice sounds simple, but it's incredibly hard to follow because it asks you to override instincts that have kept humans alive for thousands of years. Doing nothing feels unnatural, it feels uncomfortable, and that's precisely why it works. The market doesn't reward comfort, it rewards discipline. When you understand behavioral economics, you realize that the biggest threat to your returns isn't the market, it's you, your reactions, your impatience, your need to feel in control. The do-nothing strategy isn't about ignoring reality, it's about choosing which reality matters. Business fundamentals matter, long-term economics matter, daily price movements don't. I've lived through wars, recessions, bubbles, crashes, and pandemics. And the common thread through all of them is this: people who stayed calm did better than people who stayed busy. So if there's one lesson I'd leave you with, it's this: you don't need to outthink the market, you need to outlast your own emotions. And sometimes the smartest move you'll ever make is no move at all. That's the quiet side of wealth most people never hear about. Not action, not noise, just patience compounded over time.